Hi, everyone. Want to welcome everyone back, and then also want to bring in our last panelists, Jack, Mitch, and Matt. And again, I'll let them introduce themselves, but real quickly, this is the third part of our three-part series. So again, we started with kind of a macro level, talking about just real estate debt as an opportunity. Part two, we just wrapped, was more about mezzanine subordinated. Now jumping to part three, we're going into defining opportunities in senior debt in private and public markets. So want to start by obviously welcoming our panelists. I'll let you introduce yourselves, name, organization, some brief background for context, and then we'll jump into the questions. So start up top with you, Matt.
Sure. Hi, everyone. And Chase, thanks for having me today. Matt Salem. I'm responsible for the real estate credit business at KKR. KKR is a global alternative investment manager. We have about $430 billion of alternative assets under management. I sit within the real estate business. Within real estate, we have a global platform, about $33 billion under management. Real estate credit is $18 billion of that. And the strategies that we manage, we invest in and originate first mortgage loans, everything from 10-year fixed rate on stabilized properties to light transitional or opportunistic lending strategies to construction lending. We have a series of private funds where we invest in the CMBS market as well. We're one of the largest investors in risk retention CMBS B pieces. And in terms of the vehicles we manage on the loan side, we manage insurance company separate account money. We have a publicly traded mortgage REIT called KREF. KREF is the ticker on the New York Stock Exchange. And then we have a number of private funds as well.
Perfect. Jump down to you, Jack.
Yeah, great, Chase. Thanks for having me. Happy to be here, and good to see you, Matt and Mitch. And really credit to you, Chase, for doing 3 panels here back to back. So I hope your stamina is up. But
I'm good.
I manage the debt business for Nuveen Real Estate globally. Nuveen Real Estate's part of the larger Nuveen Asset Manager. It's about a $1.2 trillion asset manager, and within Nuveen Real Estate, we manage about $130 billion of real estate assets, and about $40 billion of that is private credit or commercial mortgages. So that's the part that I oversee, and it's really been subject to the conversations here. In terms of where we land, similar to what Matt said, sort of across the spectrum, a lot in the senior space with insurance company parent, 10-year fixed rate type credit, a lot for debt funds and separate accounts that are more in that mezzanine subordinate debt space as well. And it's everything from light bridge loans to construction loans to senior permanent loans. So across the risk spectrum. And then last thing I'll mention is just outside of the Nuveen Real Estate, Nuveen itself also has a separate area that manages about $10 to $12 billion of CMBS. So we work with them whenever we're looking at that. Within the private market, we do about $1 billion of single asset CMBS.
Perfect. Thank you. And last but not least, Mitch.
Thanks, Chase, and good to be with you all here. My name is Mitch Pleiss. I'm a portfolio manager at CalSTRS. I've been there 12 years. We are approximately a $40 billion NAV fund, and debt makes up about 5%. Private credit makes up about 5% of it. The primary role that debt plays in our portfolio is really stable, low-risk cash flow that beats our equity benchmark. I think Wisconsin touched on that earlier, and I think we're very similar in the way we look at our strategies. Like I said, we have a 5% allocation target, and our focus has been on construction financing, first deed of trust, construction financing, and bridge loans. And that's where we've seen most of our business. In the last 18 months through COVID, I think we've seen a real increase in our flow, and we're able to really move our allocation significantly. We have 8 partners that are investing for us in this space, and I look forward to more of this. So thanks for having me.
No, thank you. And similar to Wisconsin, maybe staying on you, Mitch. I mean, kind of he had touched on how they're pushing towards the higher end in this market of reaching their allocation. Is 5% your high end, or are you looking to expand further?
You know what, I think that is a good question. Right now, 5% is our allocation, but we at the fund level we just finished an analysis on private credit, how the role of private credit will be integrated into our whole fund, fixed income, private equity, and infrastructure. And so I would tell you right now, it's targeted at 5%, but I think that this is an active conversation on our board level on how we implement private credit, partly because, you know, the liability streams can match up really nicely with private credit.
Mm-hmm. Yeah, and just real quick before going on, I forgot to mention at the beginning, but again, for the audience, we're going to be able to open up questions here in a little bit. So want to just to get you involved, feel free to start typing in questions and we can get to them down the line. So maybe jump up to you, Matt. One of the questions we had kind of as we were preparing these panels was, I mean, just as far as the key trends in the first mortgage market today. So from commercial and residential, I'd just say, what are some of the key trends that you're seeing, and how does that impact maybe other things that you're doing down the capital stack?
Yeah, I mean, I'll make a couple of comments and then, you know, turn it over to Jack and Mitch. I'd say, I mean, first of all, I think the most notable thing is volumes. And then, you know, the pipelines, the market activity is very high across every segment of the market. You know, whether that's the short end floating rate market or you know, longer fixed rate market. And second comment would be, of course, we don't, you know, live in isolation of the broader markets. There's definitely a demand for yield and a thirst for yield that's kind of pervasive across everything, and we're experiencing that as well. So the competitive dynamic is certainly strong right now. But I would characterize the overall market as pretty balanced, given the amount of volumes that are coming through. We're not seeing a lot of spread compression or yield compression over the course of the last, you know, 5 or 6 months. I mean, you saw a fair amount coming out of COVID, obviously, from the wides of caused by that volatility, but it's been relatively stable, I would say, over the course of the last, you know, 4 or 5 months. Again, I think largely driven by the amount of volumes coming through the sector. You know, this is a comment you can make on the real estate equity side as well. The haves and the have-nots are like very apparent, where, you know, you definitely have everyone wanting to lend on multifamily, and obviously retail is untouchable, and, you know, office is somewhere in the middle, and then you got some of the niche asset classes that, you know, everyone is looking at, you know, quite closely, and so and again, it's happening on the equity side. Flow of capital is very defined right now, and I think everybody is kind of like running what feels like a very similar playbook.
Mm-hmm.
So those are a couple of high level comments. I'm sure others can add to that.
Yeah, Jack, any thoughts on that as far as kind of the key trends, not only first mortgage market, but kind of even expanding that, how you guys are looking at it?
Yeah, Matt certainly hit on some of the themes that have also been echoed on some of the other panels in terms of the competitiveness. But I guess, you know, just to start, when you think about the senior loan market, there's clearly some overlap between this market and, say, the previous panel dealing with subdebt, because you know, certainly with where Mitch and Matt and Nuveen plays, oftentimes we're dealing with senior home loans that we originate, and then sometimes we add leverage to them and they turn into subordinate pieces that we retain. But if you're talking about just the pure senior loan market for lenders that do whole loan originations and keep them on their balance sheet unlevered, that market in particular is dominated by large institutional players. And so we touched on this in some of the earlier panels, but it's banks make up half the lending volume in the country every year. Insurance companies maybe make up another 13-14% of the volume, and CMBS is a 10% or so player. But those are large institutional lenders that are making that and somewhat unlevering, you know, keeping their positions unlevered. So the volume's big, the dollars go out, they don't lever a piece. And, you know, what you have seen really post financial crisis is that those large regulated institutions have been, relatively disciplined. The banking regulators came down. Dodd-Frank came through, as was mentioned in another panel, and it put these restrictions and this oversight on banks. And again, banks making up half the market. You put a lot of oversight on half the market, it tends to have an impact in terms of keeping the market fairly disciplined. So that is a trend that post GFC that discipline has remained there in the senior market. I guess another thing that you tend to see is that some of the big managers are getting bigger, and there's been, we'll probably talk on this when we talk about other trends going on and evolutions in the market, but there are trends of traditional sort of fund managers buying into the insurance company market and things like that. So there are changes going on in the market in terms of the big lenders are getting bigger, but generally speaking, disciplined from the credit perspective because of that regulatory oversight, but very competitive from a pricing perspective, as Matt and others have touched on, in that there is a lot of capital. It is an attractive sector, and there's a lot of capital, and so I think fortunately for the real estate industry, most of the competition in the mortgage space has been on pricing, on the margins on structure, but more on pricing than it has been on structure. So it remains a good disciplined market.
Mm-hmm. And I want to get your thoughts on that, Mitch, and then also staying on you, segueing to how kind of the first mortgage market maybe is evolving and how lending structures, to Jack's point, might change in the future. So kind of two questions there for you, Mitch.
Sure. I mean, this has been talked about in all the panels, and both Jack and Matt talked about the discipline. And I that was one of my key points when I thought about this, is how Dodd-Frank, the discipline has been maintained through this cycle. Mm-hmm. And it just feels good, but it makes it more competitive. And so one of the pieces that I think is speed of execution becomes really important, especially for, we've been wrapped as a big pension fund that we could be slower than most. But I think that we've listened to our partners, and speed of execution is really important. And I think the other thing, because it is so competitive, is the relational aspect is still intact, an important part of making good deals and landing deals in this really competitive market. So I would say that those components for us, we really are looking at to make sure that we've got not overlapping sourcing strategies. In other words, we don't want a bunch of managers that are talking to the same borrowers when we look at strategies. And I think that's really important for us. So I think those are changes for us. And I also see kind of just the addition of debt funds and pension funds using that as a vehicle to get into the market, to augment their returns on the yield side. And I think that's been a good thing ultimately for the pension funds that have been reluctant over the years to get into the market and become a credit player. And I think maybe that does segue into your question about structures a little bit.
Yeah.
How do we or pension funds play and the structures? Are we in the open-ended fund space? Do we want to be in a joint venture, separate account? When you look at us accessing these debt structures, and I would say we're in all of them. And part of this is getting deal flow, because it's important to us to get to allocation. But I would say that what's really important for us is to have control. So we have to be nimble, but still have control, because really the goal or the end game for us is to beat our benchmark. And if we see appreciation run, which we're always have an eye, as mentioned earlier, on the equity, what's the equity doing, and how does that overlay some of the decisions that we make? So I would say we like control, but to get deal flow, we have to look at all the structures and be open to them.
Mm-hmm. Yeah. Any thoughts from Jack or Matt? Either one want to jump in as far as maybe what you're seeing from structures, maybe thoughts that have been presented to you from investors. So maybe start with you, Matt, as far as structures, different things that you're seeing or how you guys are looking at it, evolving views.
Yeah, I mean, I'll make a couple comments. One, just the structure of the market has changed a lot, right? The lending market itself has changed a lot. I think it used to be that you had the banks, you had the insurance companies, you'd have private lenders, debt funds, or mortgage REITs, and now what you see is much more of those underlying products being offered by one of those firms. So if you think about what Jack described and what I described, our organizations came from very different places, but yet we're offering to the market a range of lending opportunities from what you could call core, right, for 10-year fixed rate stabilized properties, all the way to opportunistic and construction. And that's just very different than I think what you've seen in the past. So, and obviously we see the power of that by being able to service our client base with multiple products and keep that market connectivity. So I think that's been a big change, and a lot of that's come with some of the consolidation in the insurance industry into the global asset managers. And so there's been a little bit of a sea change over the course of the last 5 or so years on that regard. I mean, on the loan side, I don't see a lot of like new features in loans. I mean, we're generally conservative people. We don't create a lot of new features within loans. I think that historically what you would call a debt fund or a mortgage REIT has a lot more range than they have in the past. I mean, if you think about the coupons where they play today, where we play, we have everything from LIBOR plus 250 to LIBOR plus 400. And so the range of opportunities, business plans you can lend on has certainly grown. And we'll talk about CMBS, I think, later in this panel, but it translates into the securitized markets as well because of how transitional lenders access financing through the CRE CLO market, and that's at record issuance as we sit here today. So a little bit, maybe some more comments more on just the structure of the market as opposed to like difference in what we're seeing in loan terms.
Well, and I think that's where it goes. Go ahead, Jack.
Chase, I was just going to maybe add a little bit on that structure of the market, because I mean, certainly Matt and KKR are right in the middle of it, having acquired Global Atlantic and Apollo acquiring Athene, and that's those traditional sort of higher leverage, higher risk managers moving down into what would be this traditionally unlevered, core lending. Nuveen's probably gone the other way. Traditionally had an insurance company piece and now does a lot of separate accounts and funds and higher yielding lending on the other side. And so, so you see the two worlds sort of emerging, where you have some of these managers getting bigger. And a lot of that is really quite new in terms of at least the consolidation in the insurance industry. And you could point to a couple of things that we've seen here and there with, maybe some more flexibility in lending in the 10-year sort of traditional insurance company market, where some of these newer managers are providing perhaps a little bit more flexibility on prepayments and things than a traditional insurance company would have provided before. Not something, not an evolution I love to see, because insurance companies love duration and matching assets and liabilities, and so but we've lost some deals because of call it new lenders and managers into the market, providing a little bit more flexibility on that traditional long-term core product. So that's something to watch. And I think, just the other thing is, we started on this in terms of the discipline in the industry, and hopefully the new managers, as they enter into that traditionally core market, will remain disciplined, because I think that the discipline in that traditional senior market is what allows the debt funds to still make good, relative value adjusted loans that really aren't taking on that much more risk because of the discipline there. So some trends to watch there, I think, as the consolidation continues. And but when it comes down to trends and actual loan structures, I mean, Matt said it, there's not that much innovation. I would say one trend we're seeing maybe a little bit of is the leverage markets in terms of senior loans into producing these higher yielding loans. And so you've seen evolution and expansion of the CLO markets, that that market is way up this year. So that's I'm not sure that that's something new, but it's exponential growth in that market, which has leverage into the system, and something to watch there. And I think the other piece in terms of financing senior loan books is that we're seeing a little bit more of loan on loan. So that, you know, the traditional might be a warehouse line or selling an A note. And now we're also seeing a little bit of more loan on loan structures on one-off loans to leverage a position. You know, so it's just a sign of the liquidity, right? There's a lot of liquidity in the market, and
Yeah.
different lenders are looking for different ways to put money to work, and so slight new evolutions there.
Mm-hmm. Well, and I think even taking a step back, I mean, when you talk about structures, I mean, evolution of structures, I mean, is it fair to say that there's the market, there's then the actual loan itself, and then there's kind of the vehicles as far as accessing it. So, I mean, that's where I think that's on us to do a better job as far as differentiating the structures that could be changing. And I guess Matt had started talking about it, but we do want to get into CMBS. And again, remind the audience, probably around now is a good time to start sending in questions if you have them. So jumping to the CMBS, the prior panel had kind of touched on it, how it's not as relationship focused, kind of just you're making it and selling it. Hot potato, I think, is how it was described. I mean, has that changed? So I guess the question is that we kind of had was, what is the current state of the CMBS market, and what's the outlook in the future? And maybe jump to you, Mitch, get your thoughts first.
Well, I actually think that's an opportunity in the CMBS market. If we can basically find servicers and create a market to offer that kind of direct, more user-friendly, like the life companies, I think it's an opportunity. And so I think that that's what I see in the CMBS market, is that we're trying to, this is actually a strategy that we've just taken some early steps in, is looking at sourcing whole loans and then going into the market and securitizing them. And that's an important part of our strategy, is to have a direct, our service provider, the partner that's doing that, provide the service that makes it attractive. That's one of the reasons we wear two hats. We're a borrower, we're a big borrower in the market today, and we're also a lender through this debt investment portfolio. And I would say a year ago, if you asked us, would we do a CMBS deal, that would probably be the primary reason why we wouldn't do it. Mm-hmm. And I think today, if we can fix that, I think that's an opportunity.
Yeah. Matt, any thoughts on that? You started kind of referencing CMBS.
Sure, no, happy to. I think the first comment you have to make when you're thinking about CMBS is just the performance. And we just went through a pandemic, the last or within one still, I suppose. The last big through the GFC, CMBS did not perform well, right? And I think it got a bad mark. It didn't perform well from a loss perspective, from a client service perspective. And now we just had another case study. Risk retention is in the market, and delinquencies on at least the risk retention vintages, which there's a fair amount of them from 2017 on, are de minimis, right? You're talking about 4-ish% on the highest, at the highest. So I think that the performance has been quite strong. I actually give the industry some credit in terms of dealing with the amount of forbearance requests coming through the system. I mean, talk about an overwhelming experience. I think that the servicers did a good job of navigating, the vast majority of those. And I think the investor experience for CMBS holders is going to be pretty positive for those vintages of, at least within risk retention. When you get before that, you do have some malls and, other retail exposures that people are concerned about. But really, since risk retention came in the market, I think it's been a pretty positive credit for the credit, and therefore a good experience for investors. So I think that's comment one, is that the investor base is still very much alive and very much likes the product. So that's you got to start there. If you look away from conduit CMBS, which is most of what I was referencing before, you're at record issuance everywhere. So single asset, single borrower will break the all-time record this year, probably hit 50-some billion. I mentioned before CRE CLOs, where transitional lenders finance themselves, already at record issuance where we sit today. Agencies will be, I'm not sure if they'll record, but I'm sure close to record on the agency side as well. So it feels like the market's kind of alive and well. Conduit issuance is lagging because of, hotels, retail are really being cut back on the lending side. So that's really eaten into the volumes on that side of the business. But I mean, overall, it feels pretty good in that market, and most of what's pricing is at all-time tights. I think Mitch is right. There's a whole borrower experience part of CMBS that still probably needs to be addressed. But it is the favored and probably only solution for many global asset managers. If you look at the SASB market, the biggest issuers are Blackstone, Brookfield, KKR. It is the biggest managers of real estate. So it's got to be attractive, for some reason. Primarily, the cost of capital is very efficient right now.
Yeah, Jack, any thoughts? And then we've got some audience questions that came in, but I want to get your thoughts first on this.
Sure. Yeah. Agreeing with Matt in that basically the single asset, single borrower market has clearly grown, since the GFC, and the conduit piece has sort of struggled to find its footing. Part of it is the challenge that Mitch highlighted as an owner. When you borrow from a conduit, you have challenges in terms of servicing it. If you borrow from a fund or a bank or an insurance company or something like that, then you've got somebody on the other end of the phone to call and deal with those issues. And it did play out during the pandemic when banks and traditional lenders were doing forbearance activity and allowing their borrowers to work through these issues that were temporary in many cases. And the conduit market had a very hard time doing that with the servicing structure. So it led to higher delinquencies. I think delinquencies in the conduit market peaked around 10%, and they've come down 6.5% or so now. But there were challenges. There still remain challenges in that structure. But that single asset, single borrower market is, I think, really critical to financing large assets in major cities, because portfolio lenders just don't want to have that kind of concentration. So you need that vehicle to do it. But again, the last point, just to echo Matt's piece, is that there are investors that see attractiveness in the bonds, and they buy the bonds, and they bid, I think, pretty tight. But there's still a premium to other sort of corporate bond type alternatives. So there is a market there, but I do see the growth outside of conduit.
And I had reminded about audience asking questions, but obviously want to remind you guys if you have questions of each other. But staying on you, Jack, for one second, because we do have a question from the audience. So do you see Consolidations, fund manager, insurance co, becoming a future problem, a conflict due to management, fiduciary, or even liquidity if the market turns?
It's not necessarily a problem in that it's the same capital just being managed by different managers. And again, I think that the evolution is really so new that it's still hard to draw any major trends out of it to say, well, the lending habits have changed significantly for this traditionally conservative bucket of capital managed by an insurance company to be managed by somebody else. The credit cultures of these acquiring asset managers tend to be a little bit more aggressive than the traditional insurance company credit culture. But I can't say that I've seen yet major trends in that market changing. But it's something to watch. But again, it's not necessarily a whole new slug of capital. It's just changing hands of the capital that's already in the system. So I'm not overly concerned about it. And I think again, something to watch over time as they get more involved in it.
What about you, Mitch? Any views on that?
I would agree with Jack. No, I don't see any changes or concerns.
Okay. Yeah, and I guess throw it to you too, Matt.
Yeah, I mean, I'm obviously very biased because we have that capital, so I'll admit to that. But I think that from our perspective, sure, historically, were we more transitional lenders. We were, that was where we came from. But that doesn't mean that, we're putting that type of, risk return into the insurance company that has a different cost of capital and a different, risk profile it targets. I think that the value, if you put your insurance hat on, Global Atlantic, in joining a team like ours is really twofold. One, we sit fully integrated with the real estate equity investing team, which that insurance company didn't have before, and many don't. And so we get all the synergies with underwriting properties, market relationships, data points, et cetera, to filter back into the credit side. So I think we end up with a more sophisticated analysis. And then number two, just given our presence in the market, like we've really increased their access to the institutional client base. And so we've taken, our average loan size up from, call it 40 or so million to 125, $150 million. So targeting much higher quality, real estate and sponsors, which I think ultimately will accrue, to the benefit of the credit.
Mm-hmm. And just a quick update, we have about 15 minutes left. So again, for the audience, want to make sure you have plenty of time to get in some questions. But one of the other questions we had written out was kind of talking about whole loan strategies, and wanted to see, again, open it up to any of you to jump on this. I mean, the way we had framed it is, why are direct whole loan strategies attractive? And I guess maybe you could compete. Are they attractive right now? Maybe another way to frame it to you. So maybe start with you, Mitch. How about that?
Sure. I guess for us, it is control and optionality, and because those are both important to us. That's why we would lean into whole loan strategies. And I just looking at, whole loan is defined by originating, owning 100% of the loan, having control of that, and then just having the optionality down the road. So for us, because we're, again, back to the benchmarking issue, this is still a tactical investment sleeve, and we may have to back off the gas. So it's important to have control.
Yeah. And that's a good perspective too, as far as kind of how it's supposed to fit in your overall portfolio, which I imagine it is similar for many other institutional investors. Yeah. Jack, what about you?
Yeah, look, control is certainly a big piece of it, as Mitch says, but generally a whole loan strategy is a very defensive position. There's a significant cushion to the equity of 30 or more percent. And the private market execution and having that one-on-one relationship with a borrower allows you the ability to sort of work through an issue. And I think I'm just expanding on kind of the control piece that Mitch is referencing to, is if there's an issue, you're not stuck in a bond issuance with, 50 other bond investors. It's you and a borrower, and you can work things out. And, if you can't work things out, you always have the right to take the collateral back, and the structures are good and efficient to be able to enforce your foreclosure rights. But that ability to work things out, and a lender, their first step on a problem loan is always to go try and work it out with the borrower. In most cases, the borrower is still good, if the borrower is not the cause of the problem, the borrower is still good quality institutional lender or owner. And certainly if the borrower has the ability to put more money in, you'd rather work with that. What the borrower might need is time, because there's a liquidity in the market. And if you're a portfolio lender, you can provide time in exchange for, other things, and you work it out. So I think that's, really that control and that ability to work through things in a downturn just adds to the element of it being a very defensive position. And I'd say the last piece is just these whole loan strategies, because they're private market and they're hard to access. You get that private market premium to other public securities. And when you're the managers that you'd have on to produce these whole loans, you can't just decide to go do it, setting up a Bloomberg like you could and start buying bonds or whatever. You need a broad origination and asset management team, and hopefully a broader even equity team, across a jurisdiction to get into that market. So the barriers to entry are pretty high, which is why that private market premium still exists in the whole loan market.
Mm-hmm. Yeah, thoughts on that, Matt?
I think that's right. I mean, I think
Yeah.
that there's relative value both in kind of yield and credit, largely because it's hard. I know sometimes I ask myself why we chose this business, but it's a hard business to make loans, and there's a real franchise value associated with client relationships, and I think that's through that difficulty and through those relationships, through those franchise value, you can create good returns and you can create credits that you like and that you control, with the right structure that you put on each loan. So, and it's so much different than a lot of other markets. It's generally not a syndicated, market. Everything is kind of bespoke, originated directly, and therefore you can capture a lot of the economics yourself.
Mm-hmm. Well, and going back to control and tactical, kind of how you're looking at it, Mitch. I mean, one of the very first questions that popped up in the first panel, again from a macro level, was regarding the Evergrande, not sure exactly how you'd pronounce it, over in China, and just the contagion that could have. And obviously, I think what we've heard is the shift to debt is meant to be defensive. I mean, do you see things like that obviously coming out of a pandemic? Just seems like there's risk everywhere that never materializes. I mean, does this further the defensive stance? Does it give you pause when it comes to debt, or is real estate debt kind of a defensive strategy for you?
Well, remember, we're an equity investor, so
Yeah,
we're kind of used to the risk at that top end of the capital stack. So in many ways, just as an example, we had an asset that if we would have owned, we would have lost the equity in a particular transaction. But because we were in the debt position, we could restructure the debt and get a coupon and get our money back. And so it still holds against our benchmark. So long term, being a debt investor is beneficial to our equity portfolio.
Yeah.
So.
Well, and I guess jump to you, Jack, as far as what you hear from clients, how you guys are looking at it internally. I mean, again, I think I just go back, take a simplistic view of just all the things from pandemic, just everything the last 18 months seems constant, just the wave of risky things happening, this just being the most recent. I mean, are all of these kind of events just continuing to push people to ask questions about debt, or is it more of a function of just shifting out of core and just looking for more yield?
Well, I think that the debt and private capital has found, a home for institutional investors like CalSTRS and others. And so there's, that allocation could ebb and flow over time, but it years ago, it was more like, well, there's a little opportunity to jump in, jump out. And I think, now it's more of an evolution of, you could overweight and underweight depending on how you see the world. And if you think that things are really overheating because of the amount of liquidity that's been pumped in by the Fed, and you think that there's going to be some sort of a hard landing, if you will, as we come back out of this and try and taper off, then you might say, well, hey, that whole loans are a good place to be. They're pretty defensive. That you can get an inflation hedge, if and a rate hedge if you do floating rate transactions, and so that might be a place to be. If you're sort of on the other side of it, you're not going to go. You might not go completely out of whole loans, but if you're on the other side where you think things are really going to run because more liquidity coming in system and values are going to continue to accelerate and increase, you might say, well, I'll have a little less fixed income whole loan and a little bit more equity. But many players, similar to CalSTRS, play in both. Sort of like Nuveen manages in both areas as well. And I think that there's reasons to have allocations to both, and you might ebb and flow between them. But I do think that it's a over the long run, and we've done studies with our research team that shows over the long run, particularly if you can move in and out and you're adept at the timing, but having a debt portfolio on top of your equity allocation enhances your overall return because of it really is good risk return, stands up well to equity investments as well. So it is a good long-term allocation.
Mm-hmm. And while it might be tactical, it could just be a bigger portion to that tactical component, and then it could be a longer duration, that it's not just like you said, getting in and getting out. It could just be a growing portion, and it could just be a longer tactical play.
Yeah, ebb and flow, in and out, and look, many institutional investors consider it more of a fixed income alternative as opposed to an equity alternative. So if this panel, if we're focused on whole loans, that's probably more of a fixed income alternative to say corporates. If you were talking about high yield mezz, as the previous panel did, that might be a tactical allocation between your equity investment and a mezz investment. So depending on where you're going to play in the capital stack for the mortgage market might dictate where the capital is coming from within your strategy. So insurance companies tend to have very big allocations, but a lot of that allocation is in the senior home loan market, and that's an alternative to corporates. With maybe a slight, some percentage of it, an alternative to saying farmland or real estate equity or infrastructure or something like that.
Yeah, and that's a really good way to look at it. With the time we have left, we only have about just under 10 minutes left. So want to make sure just to be able to get your guys kind of just parting thoughts, words of wisdom, key takeaways. And we'll start with you, Matt, and then I'll close this out. So yeah, just take again closing thoughts that you've had from all three panels.
Yeah, no, I mean, I think that thinking about the audience here, the relative value that you can create in this segment of the market with these kind of brands and the franchise and the client relationships that we have, I think it's pretty interesting in today's market. We just went through a stress test. Volumes and pipelines are very high for all of us, and whether you relative value to Jack's point against investment grade corporates or high yield corporates, depending on where you are in the capital structure, or against a real estate equity book, I think that the current return and the leverage point that most of us are lending at are pretty attractive. So I think that it's a sector that we've seen a lot of institutionalization over the course, really since the GFC, where a lot of people were initially attracted to the distress in the sector and then got to understand it better and increase private credit allocations, not just to real estate, but to corporate credit as well. And now it's become to some extent a permanent part of their portfolio. And I think you'll continue to see that given the attractiveness of the space and the relative value. But I spend some time fundraising for our private funds, and there's not a place you can go in the world that doesn't understand real estate credit, doesn't understand first mortgage lending or senior sub, and it is very pervasive in terms of people's investors thinking about the sector and allocating to the sector.
Thanks, Matt. And Mitch?
Sure. I think Jack touched on kind of my comment earlier, and that was, historically pension funds have really played in the equity part of the capital stack. And recently you see more and more of the funds, and I'll, talk about us, are in the debt side of the capital stack. I think one of the things that we're recognizing is that we become a much better investor when we can invest throughout the capital stack. We understand risk better. And so that's an important piece for us that we're learning, and one of the reasons we're in the debt space. But I would tell you the other piece really hasn't been mentioned, but when you can play in the debt, in the complete part of this capital stack, you get better deal flow. You get more transactions. and you talk to more partners. And I think what we've experienced is we'll do, maybe we don't do a debt deal with a partner, but we might end up doing either mezz debt or just do joint venture. And so it provides a source of deal flow that really is something that we see as a real benefit. So really better risk assessment and some deal flow from being in that space.
And Jack?
Yeah, I may make sort of three thoughts to sum things up. And I'd start with one is, look, it's been touched on in every panel, but the market is liquid and it's healthy. It's competitive, but it's remained disciplined. So, I think most of us as lenders and managers and investors in the space feel pretty good about what we're seeing, despite the fact that it is hard to win deals and it's competitive out there. I'd say number two is this was really more your macro panel in the beginning, but the recovery is ongoing. It's moved through the different sectors, starting with industrial and then multi. Debt's sort of leading the way, if you will, in some of this recovery. The debt markets loosen up. Now office and hotel, there's more debt capital available, and you're starting to see more equity transactions there as well. But there is capital flowing into real estate from abroad, from pensions domestically, but that capital flow in there is supporting values. So look, we just want to get our money back. So the values don't have to go through the roof to get our money back. They just need to stay stable, and we'll get repaid as lenders. And right now the capital flows are really supportive of strong equity flows. So we feel pretty good about what we're seeing there. And the capital that's flowing in is largely institutional. It's long-term and patient and can go through bumps like we just had with COVID last year. And I think last is just the relative value. It does remain strong. The private market piece offers a liquidity premium because it's difficult to access. It's harder than the CMBS market to access because it takes a big presence and it takes scale to really be effective in this game. So the relative value, does hold up. And, again, you can pick your spots in terms of duration and hedging against inflation with floating rate and those kinds of things. But I do think that as you stack it up, even though yields have compressed across all asset classes, that it still holds up pretty well against others.
Perfect. Thank you. Yeah. And again, just to take us out, I want to provide my just closing thoughts more on behalf of IREI. Obviously want to thank all the panelists that joined. You say this, we have weekly roundtables we host. We know you guys are busy. So we want to thank all of you for joining. Want to thank the audience for staying with us. I think as far as the way we set this up to, again, start macro, go to mezzanine, and then finish kind of more on the senior. I just want to remind people that we'll have this recording available for all people that registered. So we'll be able to send that out. And then we kind of talked about as we were planning these webinars, as far as what we kind of call just closing the loop, because we don't just want to do this and then just leave everybody on their way. That if people have follow-up questions, they can direct it to us. We can get white papers from you guys, all the other panelists that were here. So this isn't meant to just be a webinar that's just, once this is wrapped in 5 minutes, we're done. We're here as a resource. I'm sure there's going to be other questions that we're here as a resource for everyone. So again, want to thank everybody for joining. Again, piggybacking on what you guys said, I think the key things going through these three panels is, I'd say discipline is definitely something that a lot of people touched on, because you have issues of being top of the market, all of that, and shifting to a defensive position, and how do you maintain that kind of discipline. So I'd say that's a key takeaway. And then just on this panel, as far as kind of it's more tactical, but that tactic might shift a little bit versus just being, again, kind of the in and out. So yeah, so I think those were some of my key takeaways. Again, want to make sure to thank everyone. I thank my colleagues, John, Lucero, for helping coordinate this and make this go off. But again, thank you to everybody, and we'll see you at the next one next month. I think we're actually hosting another one, so we'll see you later. Thank you.